So Barry, the question is, who was selling U.S. Treasuries? And the reason I think why this is important is because it was opposite to what the administration was hoping for. If anything, they were hoping for everybody to know there's an inverse relationship between the price of a bond. If the price of the bond goes higher, the yield, the interest rate is lower, or the yield is lower. And that's what they would want, because then you're paying interest at a lower rate on all the debt that the U.S. has. So what do we make of this, that the bond market did the opposite and to such a severe degree?
All right, well, let's begin with who wasn't selling, which most likely was not the Chinese. And one way to think about that is you had very little movement in the offshore yuan, CNH, last week. It fell less than 1%. And effectively, the Chinese selling treasuries would be effectively putting a gun to their own head. It would weaken their currency further, trigger potential outflows like what was occurring back in 2015, cause a liquidity squeeze in their banking system, which has massive latent loan losses from their real estate collapse. And it's just not really a viable option for the Chinese. They haven't been accumulating treasuries in the US in a long time anyway. Now, you did have a decent move in both the yen and euro last week, some 4% rallies in each of those currencies. So you could have seen some selling on the margin from Japanese investors and European investors, but the real selling occurred in the US. And there was a technical dynamic that went on. It was a trade referred to as the Besant put. If you look at the spread of the swap rate to actual cash treasury rate, that was deeply negative. It's moved when it looked like, when Treasury Secretary Besant was confirmed, for example, it tightened. And the idea was Besant was really going to push the agenda on shrinking the budget deficit. But when all those things happened last week that I was referring to, that was a very popular hedge fund trade, treasury trader trade, and it absolutely imploded. So most of the selling undoubtedly occurred in the US from accounts that were leaning into the idea that we were going to start to cut government spending and get our deficits under control. So, yes, okay. Was there a concerning, weakness in the dollar and sell off? Yes, but was the real problem was made in America. It's our own issue, and it's a much bigger problem and far more important than the trade deficit, in my view. Budget deficit over the trade deficit all day long.
Okay, so I'm going to segue for 1 second, because when you see the market have such significant moves, whether it's the equity market or the fixed income market, and people need to understand fixed income market is much larger. So that's, to your point, I think earlier, that's when the president really heard the market. I'm really curious, and you and I have both, having lived through the financial crisis of 2008, what positions are the hedge funds in right now? How levered has the market been in the hedge fund community? Are they all doing the same trade like we saw in 2008? Are you seeing or hearing of any cracks in accounts, large accounts?
Well, there was a Bloomberg story last week actually naming some of the big losses that occurred in the hedge fund community. So there's nothing systemic really about all of this. Okay. We didn't really have a lack of functioning issue. We just had a lot of trades gone wrong. I would argue that all of the post-GFC regulatory policy that pushed a lot of this risk-taking from the street to hedge funds in an attempt to protect taxpayers was a massive mistake, that we'd much rather have the street with accordion-like balance sheets making these markets. But that's a story for another day. The market was not. The market was functioning last week, but it was sending a very strong message that we're on an unsustainable fiscal path.
Okay, I appreciate that, because you in your position and having on the institutional side for so many years, you would hear or see that, and then also your Lehman background, where I'm not as attuned to that right now, but it's good to know that you don't see the systemic risk in it. So let's move over then to the economy. And how you are seeing some of the current economic data. We're obviously in the midst of earnings right now, and they seem to be okay. And this is coming from the banks, but I don't know that you take that position. What's your thought?
Well, I do think that the economic fallout from the massive business confidence shock, much like what occurred in 1980 with Carter's credit controls, is going to occur over the next quarter or two. So there
Very,
is some
yeah. Well,
fallout to come.
okay. We'll take a quick break. We'll be right back.